Hey everyone, welcome to the KE Report in a daily editorial chatting with Jeff Christian. Jeff is the managing partner at the CPM Group. And Jeff, time for us to focus on what's happening in the precious metals, also taking into account, quite simply, the volatility that we continue to see across markets, all really geopolitically driven, trade war driven, really. Gold has really been a benefactor of all this political turmoil and geopolitics. It's up, as you pointed out to us, $600 essentially from the beginning of January. Yes, it has pulled back a little bit from that level, but overall, a lot of money has flown into gold, and it has flown into gold for over a year now, and arguably for the last about 10 years. So, Jeff, break down some of the recent nuances in what's happened with gold. It's clearly susceptible to a market sell off, but it seems to be weathering the storm a whole lot better.
Yeah, the gold price peaked at a record price around $2,800 at the end of October last year. And the following week was, I guess, the US election, and the gold price fell and it traded around $2,600, $2,700 for the rest of the year. It entered this year at $2,662 on the first trading day of January. It touched $3,200. It actually moved above it last week. That's almost a $600 move. It's come off about $200 from 3,200. We're trading at $3,003 right now for the active June COMEX gold contract as we speak. So, the price has come off about $200, but it's still really at prices that would be record levels at any point prior to February of this year. And that reflects the economic and political problems the world is facing, as well as individual countries. It's not just the United States has a lot of issues. Canada has an election coming up. You have issues in Europe, in China, in Russia, in India, in Turkey. The world is plagued with economic and political problems right now that are not being effectively addressed by governments. If anything, you probably are seeing governments in many cases, especially the United States and Russia, making things worse for themselves. So you now have the Congressional Budget Office and other independent, nonpartisan entities saying, okay, the Senate bill that is really the Senate structured that based on what Trump said he wanted. And the CBO says this is probably going to add $5.3 trillion to deficits over the next 10 years. And the cutting of waste might total $4 billion. So that's extremely inflationary and extreme additions to the $37 trillion of debt that the United States already has. It doesn't make things better. It makes things worse. That means higher inflation, lower economic growth, higher unemployment, lower employment. The tariffs on top of all of that just make it that much worse. This means that the deficits will be larger. The government will be squeezing out private borrowing by corporations and consumers. There will have to be more treasuries being sold. Given the hostilities that the United States government has been generating with governments around the world and foreign entities, that probably means that the Fed is going to have to finance these deficits by buying more treasuries and keeping interest rates higher than otherwise would be the case. So it's a pretty dire economic and political environment. And in that case, you see a lot of people moving into gold and to silver. And that's probably going to continue, not for the next few months, but for the next several years at least.
Yeah, Jeff, I think it's a wild world out there, and there's a lot more going on than just in the U.S. As you mentioned, there's global issues in many countries, and that's keeping a bid in the precious metals. I think a lot of people have maybe lost that context in just the last week or so, and what we've seen in the last five trading sessions, just because of the tariff news dropping. But there's a lot of reasons underpinning the gold price. Let's address the sell-off, though. It did lose $200 in just the last week or so. Do you think it was people taking profits in gold that had them to underpin other assets that were falling? Or do you think it has to do with that the tariffs excluded precious metals? And so a lot of people think the arbitrage between London and New York is unwinding. What do you think is the cause for the selling instead of more buying in this chaotic market?
Yeah, I think there are several things. One is the absence of buying. At $3,200, a lot of people are saying, hey, this is $600 than it was 3 months ago. Let me wait and see if I can buy a lower price. But I think that you saw two types of selling, or three types if you throw in what I consider to be a less important thing. The first thing was a lot of people saying, $3,200, $3,100, given the economic environment, I think I'll take profits. Second thing was a lot of people saying, I need to raise cash. I'm getting margin calls on my overall portfolio, on my stocks and bonds. Gold is a place where I keep cash. So let me cash in some gold to keep to be able to meet the margin requirements to cover my overall portfolio. That gold, that happens with gold. It's happened in 1980, 1987, 1993. It happens over and over again. It happened in 2008, 2009. The gold price went from $1,700 to $900, and then it went back up within a year. It was at new records. So that's the second thing. The issue of, gold and silver were excluded from the sanctions. That when we looked at the buying and the importation of gold and silver into the United States from London, Singapore, Hong Kong, Switzerland, and other places over the last several months, we saw that as reflecting various fundamental demand issues within the New York market and within the North American market. And we saw the issue of let me move gold and silver into the United States in advance of any tariffs. We saw that as a less important factor. So the fact that the tariffs came out and they excluded bullion last week, you probably saw some profit taking by speculators who had taken gold and silver positions in the anticipation that sanctions would apply to gold and silver. But I think that is just as we thought it was less important on the way up, we think it's less important on the way down.
Jeff, because so much of this is, again, this like global issue of trade wars and everything, and it just feels right now like things are only going to get worse before they get better. But we will have volatility within that. First of all, well, let's just play that card that it does continue to get worse globally and even market wise. Precious metals, are they still at risk then of further corrections here because of their higher prices? And again, because a lot of people are thinking that trade wars are simply just going to be escalating?
Yeah, gold is at risk. I mean, if you look at our short-term 1 year outlook for gold, our first thing that we say is we do think that gold prices will rise and make new records. We think it'll go past $3,200 over the next 12 months. The second thing that we say is, however, the volatility could increase sharply. The fact that the gold price came down as fast as it did, we've been telling people that we would not be surprised to see the gold price drop to $2,850 in the near term. And we wouldn't even be surprised to see it at $2,650 at some point during the second and third quarters of this year. But if the price falls to those levels, we think that you'll see renewed buying because the overall economic and political environment is still extremely negative. It's getting worse, not better. And there will be investors who say, okay, I missed it at 2,600 in January, but now I have another chance. Or I missed it at 2,800 in February, but now I have another chance. So we think that because of the factors that drive that investment demand that drives the price higher, those things are all still in place. So we think that you could see some further selling over the next 5-6 months, but we think that selling will be relatively limited because of the longer term economic realities underpinning investment demand.
Well, Jeff, just to that point that people may be waiting to have another crack at it if gold does pull back to the $2,600, $2,700 level. You've made the point on our show a couple of times that central banks are actually pretty choosy. They're looking for a good deal as well, and their cost. So, do you think that central banks would also step in at those levels and maybe shore up their balance sheets with a little more gold if we see a pullback to those levels?
Absolutely. We've seen several central banks that were buying gold over the last several years that have pulled back really since April of last year. When the gold price went from $2,000 in February of 2024 to $2,400 in early April, to a $400 increase, that would have been a 20% increase in 2 months or less than 2 months. We saw a lot of central banks pull back, and they haven't necessarily been big buyers or buyers at all since that time. I know that there are people who will tell you that central banks have been buying hand over fist in recent months, but that's actually not true. Central banks bought 40% less gold on a net basis last year than they had in 2023. In 2023, the price was trading around $2,000 an ounce. Last year, it was trading around $2,500 an ounce, $2,400 an ounce. If you see the price come back off from $3,200 back to $2,700 or $2,600, I think that you'll see a lot of central banks buying, because the central banks watch the investors. And when investors are buying and bidding the price up, the central banks will pull back. But when the investors start selling or stop buying is the more typical, and the price comes off, that's when the central banks say, okay, now this is a bargain price. Let's see how low gold prices fall before we step in. If you go back to 2022, the gold price rose to a record $2,040 in early 2022. Central banks stopped buying. The People's Bank of China had stopped buying actually in 2019, and they hadn't bought from 1,300 all the way up to 2,000. When the price fell from $2,040 in January of 2022 to $1,640 in November of 2022, the People's Bank of China started buying again. And they continued to buy even as the price rose into March of last year, when the gold price was around $2,000, $2,200. When the gold price started to spike up and went to $2,400 in April, they stopped buying and they came back into the market probably in November of this past year. So central banks are very price sensitive, and they'll watch investors. And when they see investment demand weakening, they'll wait to see how low the gold price falls due to the absence or reduction in investment demand, and then they'll step in as buyers.
What have you seen in terms of Western demand then, Jeff? So many people still say the Western investor is not there. I've been hearing that the Western investor has been coming back. Even some of the funds have seen a little bit more interest, not the interest that they've seen a decade or two ago by any means, but the metals focused funds are doing slightly better. What's your assessment of Western demand and also fund health, those precious metals or simply resource funds?
We've seen, well, the problem with resource funds is a lot of them can't invest in the metal. They have to invest in the equities. And the equities have not kept up with the metals for a variety of reasons. So they're kind of hurt. But what we've seen is weaker retail demand for gold in the West, but stronger, much stronger institutional investor demand. Family offices, high net worth individuals, institutional funds, money managers, specialty funds, generalist funds, funds that have exposure to Canada, funds that have exposure to Latin America, sovereign wealth funds. We've seen a lot of increases in investment demand for gold and to a lesser extent silver from larger investors and institutional investors in the West. And so when we kept hearing about, oh, the Western investors are not in the market, we were a little bit perplexed because we've been running flat out with new institutional investor clients and high net worth individual clients, keeping up with them because they're buying gold. And what you're seeing is that in the West, if you want to buy gold, the best price point is 1 ounce. If you're a smaller retail investor, it's a 1 ounce coin. The fractionals are very expensive. The medallions have bad resale issues. It's a gold coin. It's a 1 ounce gold coin. 1 ounce gold coin is like $3,000 today. Most Western citizens cannot afford an ounce of gold. You know, 40% of American households have like $3,000 in the bank. So they could put 100% of their wealth into a 1 ounce of gold, but they'd have to sell it as soon as they needed to draw down something in their financial accounts. So I think that you've seen retail investors in the West priced out of the gold market through physical bullion. They can buy ETFs if they're involved in equity investments. But I think that that's what you're seeing. You've also seen, until April of last year, you saw 2.5 years where the amount of gold being held in ETFs was being drawn down, even as the amount of physical gold being bought by investors was rising. And that was not so much a matter of Western investors selling their gold as it was Western investors, including institutions, saying, I want to own physical gold directly. I don't want to own a share of an offshore company that owns gold and that share is not necessarily convertible to gold at a reasonable price, if at all. So what we saw were investors saying, I'm much more worried about counterparty risk in the financial sector than I am about gold prices falling. And they were selling their ETFs, but buying physical gold stored someplace, allocated or unallocated on their account, direct ownership. So I think that that's what we've seen. So we really haven't seen, retail investor demand, yes, that's been suffering. It's been suffering because retail investors don't have enough money to buy an ounce of gold in the West. And in the East, they can buy gold because it's sold to them in 10-gram pieces and very small pieces at prices close to the domestic market. But we've seen a lot of institutions buying gold really for the last couple of years. And it has accelerated over the last 4 months, 5 months.
Well, Jeff, let's also bring silver into the equation with some of the people maybe being priced out of the higher cost gold when gold rips above 3,000 or 3,200. Have they turned to poor man's gold? Has there been an increase in silver demand?
Yeah, there has been. And, that's one of the reasons why I guess, people ask us, why has silver lagged gold? And our standard response starts with the fact that gold is seen universally as a financial asset and a portfolio diversifier and a hedge against currency market volatility and inflation. Silver is much more of a Western investment product. There's a lot of silver demand in China and in India and other parts of Asia and in the Gulf region, which a lot of people don't realize. But the Middle East has always been a pretty big market for physical silver too. But it's really North America where you see a lot of the demand for silver investment products. And that reflects to some extent the fact that you can buy several ounces of silver even if you only have $3,000 in the bank. Yeah, so you can use silver to diversify your exposure to the dollar or to whatever currency you have much more readily for a retail investor than you can gold.
Jeff, I want to talk these scenarios again. Look, everyone's so just on the same side of these things that these trade wars are going to get worse. Geopolitics is going to get worse. Anger, hatred, it's going down the wrong road and there's no turning back from that. But look, we have seen at the blink of a tweet things turn and maybe a different tack being taken if we do see a cooling down of trade wars, recession fears, all this kind of stuff. What happens to the precious metals? Because we do have to consider that precious metals have been going up. Gold's been going up for 10 years now, and it's really going up even before Trump came into office. So, taking trade wars out of it, say we get a cooling down there, how do precious metals react to that?
Well, yeah, there are several scenarios. CPM Group just constantly builds scenarios. We had one client that used 30 different scenarios. And we have all sorts of scenarios, and then we assign probabilities to them and figure out what is the most likely course of gold given the range of probabilities assigned to various scenarios. And we do have scenarios. One of the scenarios is not so much that things get better, but that we go into a recession. We've been talking a lot about previous bull markets for gold and silver, and when did they peak relative to a recession? And each economic environment, each scenario historically, each move into recession and through recession and into recovery has been quite distinct. But the one that is perhaps closest to where we are now is 1978, 79, 80, when the gold and silver prices, along with copper and oil and aluminum and a host of other goods, rose very sharply prior to the recession. And once you got into the recession in the first quarter of 1980, gold and silver sold off. So that's one of the scenarios where we see gold and silver prices coming off, is not so much that the economic environment improves, but that it throws us the chaos that you're seeing now, the uncertainty, the reductions in business investment, the reductions in new employment creation, the rise of the trade war, all of that throws us into a recession, and gold and silver could come off in that kind of environment. The other other scenarios, which along the lines of what you're talking about, there are all kinds of scenarios. What happens if the United States finds its sense, comes to sense, says to Ukraine and Europe, yeah, let's end this war the right way. You've got all these weapons, you've got the F-16s, use them. Cut the supply lines to the Russians. They'll have to fight their way out of Ukraine with the supply lines gone. That could significantly reduce international tensions. And you could see in that kind of environment a reduction in gold and silver prices. Gold comes back to 2,600, maybe even goes lower. Silver comes back to $28, $26, maybe even goes lower. So that's one of the things that you could see. Another one is, the tariffs, the trade wars, that all of that comes to some sort of resolution faster than one would expect. That could also lead to some decompression in gold and silver prices. Yeah. There are all kinds of scenarios where you could see things getting better economically or politically, and you could see gold and silver prices rise. There are other scenarios where things get ostensibly less militant. The United States forms a pact with Russia and China. That would probably be bullish for gold, because there are a lot of people around the world who wouldn't want to see that. It could be a reduction in international political tensions, but it would be the kind of reduction in international tensions that would probably cause a lot of people to race into gold and silver.
All these scenarios. Hey, Jeff, this is really a scenario-driven dream for these people that want to play out all these different ideas. We just don't know what's happening. But right now, man, there's a lot of scenarios that point us and the US broadly in a very negative direction. Who knows if that all changes, or who knows if this will be that long-awaited recession, market pullback that does always create some great buying opportunities. The big question is just how long, how far, and how deep these corrections and recessions go. Again, Jeff Christian, managing partner at the CPM Group. Always great chatting with you, Jeff. We'll chat with you next month. I hope you have a great rest of your week.
Thank you.